The stock market buzzed with energy, but within days, that excitement turned to dread. Just 2 weeks after diving into a high-flying tech stock, the price crashed by 30%. Red numbers blinked ominously on the screen, and the investor's heart dropped. What once felt like a golden opportunity now resembled a sinking ship. Now faced with a critical decision, they hesitated. Should they sell and limit their losses, or cling to the hope of a rebound? The loss, $2,000, loomed like a thundercloud, making it hard to accept. Letting go felt like admitting defeat. What if it bounces back tomorrow? They questioned, their mind racing. Days dragged into a week, the stock stubbornly hovering near its low. Each portfolio check felt like a taunt. They were caught in a web of loss aversion, where fear blurred rational thought. Instead of assessing the situation, they fixated on that vanishing $2,000, believing that selling would only confirm their misjudgment. Meanwhile, what would a rational investor do? They'd evaluate the fundamentals, analyze market trends, and recognize the necessity of risk management. Instead of chasing ghosts, they'd consider the opportunity cost of clinging to a sinking stock. With the price consistently trending down, they might have cut their losses and redirected their capital into more promising ventures. 2 weeks later, disaster struck again. The stock dipped another 15%. Now, the loss swelled to $4,000. Trapped in indecision, they found themselves justifying their choice. After all, they had invested time and effort researching this stock. I can't just let it go, they reasoned. What if it makes a comeback? But staring at the screen, they knew their inaction stemmed from fear, not strategy. Rationality slipped away, replaced by stubborn hope. Each moment spent clinging to that stock was a moment lost. They were passing up better opportunities, more stable investments in emerging markets or reliable dividend stocks, perhaps. Market sentiment shifted ominously. Analysts began downgrading the tech sector as economic indicators hinted at a slowdown. Layoffs and declining revenues saturated the news, yet they still clung to their position. The threat of further losses loomed large, but so did the fear of regret. What if I sell now, and it rebounds tomorrow? They thought, torn between logic and emotion. In stark contrast, a Stoic investor would recognize the market's indifference to personal feelings. They'd know losses are an inevitable part of investing. As painful as it is, sometimes the best move is to let go, freed from the burden of past mistakes. Finally, after weeks of torturous indecision, the stock took another hit. This time, a 10% drop. The accumulating losses felt unbearable. In that moment of despair, they realized that by holding on, they had deepened their losses and missed the opportunity to reinvest in something with better potential. They could have taken that $2,000, shifted it to a more stable asset, and perhaps seen a modest gain. Instead, they were left with a sinking feeling and a portfolio that now felt like an anchor. In the end, that high-risk stock became a vivid reminder of how loss aversion can cloud judgment, leading to decisions driven by fear rather than strategy. That experience served as a lesson in balancing emotion and rational decision-making in investing. A lesson that perhaps next time, they might choose action over hope.